Hello, my name is Tyler Carling, and today we'll be discussing the taxation of unrealized gains. To begin, in 2022, the Department of Treasury, in their administration fiscal year 2023 revenue proposal, aimed to address the taxation of high wealth individuals, specifically in regards to capital gains. Capital gains are taxed at a lower rate than regular income, with the highest being 20%. However, through IRC 1014, basis of property from a descendant, taxes on capital gains can completely be avoided through what is called a step up in basis, to where if when an individual dies, any unrealized gain will automatically receive a basis at the fair market value at the time of death, therefore eliminating all of that income where no tax will be paid by the heirs. Similarly, when looking at individual investment accounts and retirement accounts, which are generally utilized by the middle class, such as 401ks and IRAs, their taxation can be treated different. IRAs and 401ks have a required minimum distribution per IRS publication 590B, where at the age of 73, individuals must start distributing cash from those accounts. This forces those individuals to realize those gains, which would be essentially the same investments if held in an investment account, but they do not receive that benefit of the step up in basis. In fact, when that individual dies, per the IRS publication 590B, the person who inherited is forced to distribute all of the income from that account within 10 years. And then those distributions are actually taxed at a regular rate, and so they are losing that benefit. To help eliminate this, in that same proposal, the Department of Treasury has proposed a minimum tax rate on all individuals with an income of more than $100 million. Now, this $100 million would include all unrealized gains or capital assets as well. The tax would be a 20% tax and be considered a prepayment that is eligible to be credited against any of the income once those gains are realized. Now, Paul Bonner, in his 2022 article in the Tax Journal titled Billionaires' Minimum Tax Could Pose Difficulties, agrees with the fact that the current tax laws provide benefits regarding capital gains, specifically with high wealth individuals. But he does point out the flaws of the Department of Treasury's proposal, namely that how does one measure wealth versus income? What happens to the tax paid on those unrealized gains when those assets depreciate in a year? Also, what happens to those prepaid credits upon a person dying? Do they go to the person inheriting it? If that person inheriting it gets a step up in basis to the fair market value, then they will have prepaid on income that is no longer going to be recognized. Now, taxation is already a polarizing issue, and with an election looming at this point, it made it even more so, which begged the question, is it constitutional? To assess this, we can look at the recent Supreme Court case, Moore versus United States, which centered around a TCJA implemented mandatory repatriation tax. This tax was on American-owned foreign companies, and it required individuals who made investment in those companies to pay a tax on the increase in their investment over time. The Moores filed this litigation claiming that while they had invested in this company, they had not received any dividends or distributions. Yes, their interest in the company is increased, but they received no actual realized income, and therefore the tax is on unrealized gains and unconstitutional. Ultimately, the Supreme Court ruled against them and said that even without a realizing event, the government had a right to tax this particular type of income. Now, another area to assess is the difference between federal and state laws in their treatment of tax and their treatment of accelerated depreciation. Federal laws allow Section 179 and 168, or bonus depreciation, to where you can essentially, on certain qualified property, expense it in a given tax year up to a certain dollar amount, therefore avoiding having to capitalize it and depreciate it over the life of that specific asset. Now, the state of Ohio outlines in revised code section 474701 that for Ohio state income tax purposes, all section 179 and 168 bonus depreciation require a 5/6 add back. Now, how this relates to unrealized gains is that what if an individual has a passive activity loss? Celia Lau, in her 2023 article, Passive Loss Limitations on Rental Real Estate, outlines that while many Americans believe passive activity losses will offset taxable income, this is not the case. It can only offset other passive activity income, not taxable income. So passive losses get carried over to the next year. Now, in relates to the state case, you receive no loss on your federal AGI, yet you are forced to add back 179 depreciation. So you have no income received that you are taxed on federally, but at the state level, your add back of depreciation gets added back to your federal AGI to get to your state AGI, therefore generating a tax liability on an asset where no income was realized. So now going forward, what are we looking at? First, for the state of Ohio, House Bill 116 aims to eliminate the Section 179 and 68 add back. Russ Keller, in his House Bill 116 fiscal note, outlines that really all this does is for the state of Ohio is it pushes income forward into more current years and reduces income in later years. So this House bill will decrease income, but it'll be recouped over time. Now, federally, while we see these aspects of, the tax benefits in the Moore case, in their decision for the Moore case, Judge Kavanaugh actually made a note to implicitly state that while they're ruling in favor of the Moore case, this is in no way to be interpreted as resolving the dispute over whether taxation requires realization for income. So while there are certain laws and loopholes to where it seems that unrealized gains are taxable or certain tax laws can generate unrecognized revenue, it is still unknown whether any future law or any future taxation of unrealized gains would be constitutional or even proposed. Thank you. Have a great day.